to have conveyed a more positive message on the performance on the first half, but it's been an unremittingly grim period for markets, and the UK markets have fallen sharply, with the UK smaller companies being hit even harder and underperforming larger companies. And that's largely due to the composition of indices. The FTSE 100 has been largely dominated by oils and gas companies and banks. And as a consequence of that, smaller companies have underperformed, and we have underperformed our benchmark. And that's all been about the macro. We've had the rapid rise of inflation and interest rates. We've had gas uncertainty running up to the winter, and consumer spending in the UK coming under severe pressure. And all of that means that not only are small and mid caps out of favour in the UK, but our style of investing has been out of favour in the UK, as the market has favoured more value orientated companies rather than our high quality growth companies with momentum. As always, we stick to our process. It's a very disciplined process based around quality growth and momentum, and we don't change what we do just to suit the top-down macro. And this process has been through 5 economic cycles before, and we've been through difficult times before, and we stick to our knitting and really just focus on our stock specifics. We've got 56 holdings in the portfolio at the moment, and it's been really consistent around that level. It's a concentrated portfolio, and that's because we really like to back our best ideas and we run our winners. What we have seen, though, is that the market is becoming increasingly dominated by downgrades to earnings. And what we've been pleased with is that resilience to earnings that we've seen in our portfolio. Upgrades to earnings are really difficult to come by at the moment. And we think our portfolio has been resilient and held up really, really well. What we are seeing, though, is that as we move into the second half, upgrades are going to become more difficult to find. In terms of what we've been doing in positioning, like I said, we stick to our process. We've got a portfolio full of quality growth and momentum names, but we've been paying more attention to the quality factors within our matrix, and we've been topping up more defensive names. We're never short for ideas. We get ideas from our matrix, from our colleagues in our global smaller companies team, and we've added 2 really high-scoring names. One is Spirent and the other is Serica Energy. Now, Spirent provides products and services that enable testing of global wireless and cloud networks. And this is real mission-critical stuff. And that makes the barriers to entry really high and allows Spirent to earn outsized returns on capital. And owning this through a recession makes sense because the telecom carriers and the equipment makers are unlikely to materially reduce their multi-year projects and spends on this. And a lot of it is to do with the 5G network build-out, which has had significant capex spent on it already. We know the company well. We hold this in other funds that we look after, and we had a really good meeting with management team, and we can see the clear momentum that they've got in that business, and that's been demonstrated by the run of upgrades. What we like about it is the strength of the order book, and that gives us real visibility and confidence in the outlook for not only this year, for the outer years as well. What the management team have been really good at in this period is cost control, and they've been managing to put through selective price increases, and this has allowed them to protect margins despite all the inflationary headwinds, and that for us is a clear sign of the company's pricing power. The business generates a lot of cash, and it's supported by a really good dividend yield. We've added a new holding in Serica Energy, and this is a gas production company with North Sea assets based in Aberdeen. And this is an area of political stability versus other names in the resources sector. And this management team have got a really good track record of acquiring and improving the production of assets, and they make them more efficient and more profitable relative to expectations. And while the gas price is a real driver for this stock, and it's proved volatile, but we believe that the structural shortage of gas in the UK will provide support for these earnings, and there's not much in terms of forecasts for ambitious pricing. And what they've got is a stable production, and this business generates really, really strong cash flows. And at the moment, Serica has been a significant beneficiary of what is a historically high gas price. And this then, of course, is translated into record financial performance. And against this backdrop, Serica is really well positioned in the short to medium term as Europe battles with an energy supply crisis. And given the visibility they have with that gas-weighted production, and also the really good into the longer term, because of the strength of the balance sheet, allows them to continue investing not only in the existing portfolio, as well as being able to do some M&A-led growth as well. We topped up our holding in FDM. This is a business we know well. They train, recruit, and deploy specialist IT consultants to work within their clients around the world. And the business is still seeing really strong levels of demand for their consultants in all regions. And this has driven record levels of recruitment and training. And what the management are doing is further investing into the group to put the building blocks in place for further strong growth. We also topped up our holding in Midwich, which is a value-added distributor of audio-visual equipment. And what we're seeing there is geographic expansion driving growth as they continue to take share, thanks to the differentiation within the model. Current trading at Midwich is really strong, and they're improving margins by shifting the portfolio mix into more technical AV products. And this business also is one that generates a lot of cash. The balance sheet's strong, and this has allowed the management team to complement such strong organic growth with selective M&A. What we've seen for this business is real evidence of execution on the long-term strategy. And management are also really confident about the outlook from here. We've reduced exposure to the retail and consumer names, whilst we believe we are in really strong retailers like Dunelm, like Greggs, like Hollywood Bowl and Pets at Home, Games Workshop. We believe sentiment towards the sector is not going to be good in the short term, and we've taken some cash off the table there. Having said that, of course, we have had some really good updates from Dunelm, Greggs and Pets at Home, showing the resilience within that business model, but unfortunately share prices are yet to respond to such good updates. We've exited holdings in Synthoma and CMC Markets. In Synthoma, we believe that the boom in the nitrile latex market, which we saw during the pandemic, has come to an abrupt end, and we've seen destocking. So prices and volumes in this area are down heavily year on year. We took the decision to exit the position given that we've got concerns around the impacts of recessionary headwinds and the leverage within the business. We exited CMC Markets as well. Cost overruns are becoming a feature of trading updates at the moment, but the size of the one at CMC was unexpected. Now, this business is making real progress on their strategic initiatives to broaden out and increase visibility, which is the right thing to do longer term, but profit warnings have become a feature and poor communication with the market is becoming a trend, so we decided to exit that position. The biggest holding in the trust at the moment is a company called Telecom Plus, and this is a real cost of living crisis winner. So you might know it as Utility Warehouse, and what they have is a really unique partner model. And they have self-employed partners who are motivated to sell a bundle of really affordable telco, utility and insurance services to friends and family, and that gives them a second income. This business is in a really strong position at the moment, particularly post the energy price guarantee, where the government action to cap customer bills for the next 2 years has some really important drivers for Telecom Plus. So it effectively embeds the company's position in terms of competitive advantage for customer growth. It means churn should be minimal, and they protect the company's existing base. And it also materially reduces the potential for bad debts. And what we believe for this business is that Telecom Plus is in the early stages of a real multi-year growth opportunity. And the opportunity then is for them to materially increase customer numbers. And by doing that, they increase profits and so dividends. And what we've seen in the recent past has been a series of upgrades where they've told us that profits will be materially ahead of expectations. And that's because they're doing just that. They're really accelerating customer growth and giving these multi-service discounts. And from here, management still continue to reiterate a strong outlook. And our second holding we should bring to life is Alpha FMC. And this business provides a range of consulting services to the asset management and financials industry. And what they do, it's a really high quality play on the growing demand for consulting in the industry, and that's driven by rising cost pressure and regulatory change. And we expect these trends to continue, so driving the demand for alpha services. And they've been a really great example of our process. They've broadened out the offer by growing existing services. They've added new service lines, added new locations, as well as doing selective M&A. And this business has delivered some exceptional performance, which has been a real strength to the testament of that business model and the advantage that they have. And this business has simply just gone on and won share. While the outlook for the industry remains more uncertain, we take comfort from the fact that the management tell us that they've got a very, very strong pipeline and better than ever revenue visibility with clients. And that's because they've got the commitments from really complex business projects. Another attraction of Alpha FMC is that this business also generates a lot of cash. Cash is around 16% of the market cap, which is on the balance sheet at the moment. And that not only supports the 3% yield, but it also gives them the flexibility to return cash to shareholders or indeed do more M&A. Themes for us are very much outputs rather than inputs, but themes do emerge. And one theme which has been particularly buoyant post-pandemic was that of digital transformation. So digital transformation and, in fact, consulting. And we've seen that through the momentum we've seen in our names like FDM, like Alpha FMC, and indeed Midwich. And this theme continues to be very, very strong. With inflation at high levels, the quality focus in the portfolio becomes really important. And what we're focusing on are those names which are going to be winners at the other side. And often what we see that in times of dislocation and difficult macro, it's an opportunity for our smaller companies to really take share in difficult times. And that's because they've got more resilient business models. So what we've been doing, as always, is spending a lot of time with our management teams, questioning the integrity of order books, looking at visibility, looking at pricing power, and really focusing on the levers that the management teams have to pull to maintain earnings growth in difficult times. Things are really difficult to call. Uncertainty is still very much at the forefront, but we stick to our process. And we've run this process in the UK through 5 economic cycles, and quality growth and momentum has seen difficult times before. And we continue to focus on the qualities that are more resilient. And the turning point for market generally occurs when the outlook is at its worst. And now, granted, relative valuations for smaller companies to large caps are at really low levels, but we don't think we're at the bottom yet. Having said that, though, when we look at previous bear markets and when markets do start to recover, new highs are reached relatively quickly. And we'll always encourage you to have a long-term investment horizon when looking at small and mid-cap companies. Market timing can be really, really difficult, and we would encourage strategic allocation towards our asset class. And while a cautionary attitude to small caps versus large caps may continue in a recessionary environment, we believe that in the next recovery phase of the cycle, enthusiasm for small and mid-cap companies should typically lead that recovery.